All right, everybody, welcome back to another episode of Capitalize on Retirement. Today, we're talking about one of our favorite subjects, taxes, and we're going to talk about the retirement tax bomb that most high earners never see coming.
Yeah, I mean, a lot of people spend their entire career kind of building their wealth, but they never really realize that there could be the biggest expense in retirement could actually be their tax bill.
Yeah.
And so, we talk about this a lot. We love talking tax planning, and I think this is one of the areas that really moves the needle the most.
But we don't control any of that.
Right.
Like, that's all through your investment plan. We're
Right.
trying to help with that, but we don't control any of that.
We can
right?
minimize risk. We can help as much, but we can't control what Apple stock's going to do day to day.
Exactly. We're not in those meetings, right? We can't control that. But from a tax planning perspective, you have total control over your income from the day you retire, for the most part, until you reach that required minimum distribution age. So I think it's important to note that you do have control over your tax plan, and the government gives us a tax code, which creates opportunity for us. And I think if you would ask almost any American what their number one expense would be in retirement, it's probably going to be fairly close. But depending on how good of a saver you've been, I bet you most people would tell you healthcare.
Yeah.
But I think in reality, it's most likely taxes.
Yeah. I mean, if you think about it, if you have $1 million saved for retirement and you're in the 22% tax bracket, essentially the government owns $220,000 of your IRA. So it's a big tax bill. And the goal is, how do we get out of it in the most tax efficient way? We're never going to avoid taxes. Like, we're not sitting here saying you can avoid them, but how do we limit them or minimize them over time? That's the goal.
Yeah. And I think, just to piggyback off what you just said, most people don't realize, because, when you see your statement through Fidelity or Charles Schwab or whoever it is, and it's your IRA statement, and I got $1 million in here, I think everybody thinks that that's all their money, but it's not.
Right.
A portion of that is Uncle Sam's.
They should put Uncle Sam on the statement.
They should put him on the statement, right? Because every single dollar that comes out is taxed at ordinary income tax rates.
Yeah.
Every dollar. So I think it's not true what's actually on our statement, because we don't own every dollar of it. We can't liquidate it and cash that in.
Right.
Right.
Definitely.
So it's about what we keep in our pocket. So, it's not always, retirement planning isn't always just about growing your assets. That's your investment plan. That's the goal of that. But it's about controlling taxation, not just any given year, but throughout your entire retirement, throughout your lifetime.
Yeah. So let's talk about the problems that nobody really talks about. Tax-deferred accounts create future tax liabilities. That's number one. So as I'm putting money into this account, this IRA, 401k, 403b, these tax-deferred accounts, all that I'm doing is I'm kicking the can down the road. And I'm saying, I will save tax dollars today on a small amount of money. I'm going to let that account grow over time, and then I'll pay the tax bill as it grows to that big amount. I'm going to pay it on all those dollars that it grows to. So I save taxes on a small amount, pay taxes on a large amount. To me, that's not a very fair structure.
No, I mean, I think in part of that is, let's be honest, the government's been playing chess.
Yeah.
Right. So we've been incentivized to put money in these 401ks, 403bs, these IRAs, these tax-deferred accounts. We've been receiving tax deductions on the way in.
Yeah.
Then they've grown, and we've been receiving profit sharing and matches, right? We've been incentivized to put money in here. They've grown to be our largest asset. But the problem is we've never paid taxes on that.
Yeah.
And I think we've always been under that assumption that, hey, I'll be in a lower tax bracket in retirement, but we're not seeing that because families are spending more income in retirement. They're traveling, they're doing more things. So we're not in lower tax brackets. And then from my perspective, our country's in a $40 trillion deficit. How does our government raise money?
Yeah. I mean, there's only a couple ways that they could pay for it. They could raise the revenue that they're bringing in, which is hopeful.
Yeah, I think that'll happen.
Or they raise taxes. And in my opinion, like you said, I mean, I really feel like taxes have to go up in the future.
Yeah. I mean, we don't know when that's going to happen, but it kind of makes sense, right? So I just think most retirees are unknowingly essentially tax trapped, right? They don't necessarily realize that all of their IRA or 401k is going to be taxed at some point. And I think the other thing is they're going to be forced to take money out of here.
Yeah. Yeah, so let's talk about that. I mean, when we get to retirement, most retirees retire anywhere from age 60 to 70, so somewhere in those
Yeah.
years. So let's just call it 65. Let's say we have
Yeah.
a retiree that retires at 65. And for some people, if you're born before 1960, your RMD age or required minimum distribution age is going to be age 73. If you're born after 1960, it's going to be age 75. So for that person, they're going to be age 75 are going to be their RMD age.
Mm-hmm.
They have 10 years where their income is probably going down.
Mm-hmm.
We could take advantage of those 10 years and start shifting money to tax-free accounts when we're at historically low tax rates.
I think that's the biggest key, right? Because you mentioned it, they have control of their income. It's likely going down. But the main thing is we're in historically low tax rates right now.
Yeah.
I mean, taxes are very low. We have very generous standard deductions. Like we can take advantage of that through tax planning and start to shift money from these fully taxed accounts for us that we're going to be forced to take money out to, or next generations going to be forced to take money out of and pay taxes on, to these tax-free accounts. I just think that's a huge opportunity.
Yeah. I mean, and we have some, let's just talk about younger clients as well, because this is more for our retirees, but even for younger clients saving money. I mean, some of our younger clients are saving money into Roth IRAs, paying the taxes even though they're in higher brackets, because they want that money to grow tax-free and not have to worry about where are taxes going in the future.
Yeah.
And I agree with that. I think there's something to be said about paying the tax on a smaller number today, letting that grow to a larger number, and it being tax-free.
Yeah, I mean, especially if you're young. If you're young, you have compounding interest on our side, so you'll kind of make that up. Even if you're older, though, then it kind of becomes a little bit of a math game, right? Well, what are my future RMDs?
Right.
What's my income now? How much am I going to be spending? And then how much more am I going to need when these RMDs kick in? Like, we'll see people having $100,000 required minimum distributions, more than that fairly often, and they don't need all that money.
Yeah. We have a family that we work with, and we projected out their required minimum distribution. They already had like $100,000 a year between pension and Social Security. They were going to have $150,000 RMD. Now that's a large RMD.
Yeah.
But what that was going to do is that was going to push their Medicare higher, because they were going to go over that first Medicare tier. It was going to make them be in a higher tax bracket. It was going to cause them all these problems. And then they were going to be there forever.
Oh, yeah.
So if you start doing the tax planning early on and you do it often, it really benefits you long term.
Well, let's just even back up on that situation, right? So I got $100,000 between Social Security and pension, and then at age 75, I'm forced to take out another $150. Even though I don't need it, I still got to take it out and pay taxes. Well, if you're married filing jointly tax brackets, that is much more favorable than a single filer tax bracket.
That's definitely true.
So let's say one of us predeceased the other. We call this the spousal tax trap. So one of us predeceased the other, not to be morbid, but let's say that happens. Now we still have the pension coming in, most likely. Yeah. We have the larger Social Security staying on, but the RMD is the exact same.
Right.
So now that's bumping us through 3 or 4 Medicare brackets.
Definitely.
Paying more for that. And that's probably pushing us into a much higher tax bracket than we would have been as a married filing jointly couple.
Now that you say that, we actually ran their Medicare premiums based on that as a single filer. They went from the lowest amount for Medicare is $202 a month, $202 a month. Their RMD would push them to $284 a month.
So the third bracket.
Yeah. So they were going to be in like $650 a month as a single filer. So instead of $200 a month, they're going to be at $650. So it was a big jump as a single filer, and there's nothing you could do at that point. But if you do the tax planning and you have your money in a Roth IRA, there's no required minimum distributions on a Roth IRA. You already paid the tax. It's there tax-free. You could use it if you want to.
Yep.
You could spend it, or you could just keep letting it grow tax-free.
Yeah, passes to your beneficiaries tax-free. I mean, I think there's huge advantages of that. And by all means, we're not telling anybody out there to go convert their IRA to a Roth. What we're telling you is you need to have a plan for this. You need to work with someone who understands not only just the investment plan, but how the tax planning and how the integration of those two worlds together can really help you, your family, and the next generation.
Yeah, definitely. And I think, converting too much at one time could also be problematic. Like you don't want to do too much at one time. You want to do the perfect amount. And especially for retirees who income are going down, they should absolutely consider it. And if you're younger, I mean, even in that 22 or 24% bracket, like it's kind of beneficial in a lot of ways to start converting and getting money to tax-free, let it grow tax-free for a long time.
Yeah, no, I agree. And you mentioned one of the mistakes that we see, and I think Roth conversions have kind of gone mainstream over the last couple of years, and we've been doing this for a long time. But they've kind of you hear more and more about them now than you did 5 years ago. So
people talk about it, but the execution is what really matters.
That's the thing. And we have a lot of do-it-yourselfers who, they'll come into the office for the first time and they're doing them. Like they're really excited and we love it. Like we're all for Roth conversions. I mean, but we'll see them, they're doing huge amounts.
Right.
Because they don't have a plan. They're kind of just picking a number, but then I see they're pushing into these really high tax brackets.
Right.
They're triggering these IRMA penalties. And it's like, hey, if we just stretched it out and did it, I don't want to say did it right, but did it with a little bit more elevated planning style, we could lower this tax bill and get it done all the same. You're just triggering a higher consequence.
Absolutely. Yeah. And I think it's sometimes like what we've seen, and we have the CPAs here now who understand this, who are, all for the tax planning piece of it. But a lot of CPAs don't want you to pay tax in the year that you're in.
Yep.
Right. So when you do a Roth conversion, you have to pay the tax to get it there, but then it's tax free moving forward. And a lot of CPAs don't like that because they look at your tax bill and what you did this year and they're like, you're paying more tax. Why are we doing that? So our industry between the advisors and CPAs, it's very disconnected. And that's what we've done here at Capital A is just connect those pieces.
They have to be connected. That's one of the things that I hear most from the families that we serve. I love that everything is in-house. And we've chosen to do that because we believe it has to be. Because
definitely
the coordination between us and the CPAs, like external CPAs, not that we can't do it, but there's a disconnect. They don't understand how much money they have. They don't know what their future RMDs are. So they're seeing us doing these Roth conversions and just can't figure out why.
Yep.
Where our guys in-house, they understand what is happening, why we're doing this. They understand the future tax liability for not only the family, but also the next generation.
Yeah. No, that's a good transition. Let's actually talk about that. So the legacy transition, whenever we're passing money on. So the Secure Act actually changed a lot of this.
Mm-hmm.
The Secure Act said, hey, everybody who inherits an IRA, you used to be able to do what's called the stretch IRA.
Yep.
We could stretch out those distributions from an inherited IRA over our lifetime. So it would be very little that we would have to take out. We'd pay little tax on it. Whereas, let's talk about what happens when you inherit an IRA today. And those kind of the downfalls of that.
Yeah, so the Secure Act, a couple good things it did. It delayed RMDs until age 73 or 75. Now, is that a good thing or a bad thing? It gave us a couple extra years to do some tax planning, but it also increased the RMD.
Yeah.
But the main thing that the Secure Act put in place was that anytime someone inherits an IRA after 2020, they have to distribute that entire account over a 10-year period. So like you mentioned, you used to be able to do what's called the stretch IRA and stretch it out over their lifetime. Now the entire account has to be liquidated over a 10-year period. So if it's a large IRA, all that money is taxable on top of their already high income. The parents maybe have opportunity to convert in 12 or 22, but when it goes to the next generation, they may be paying 32, 35, or 37. So we're just losing money to the IRS. And we have conversations with families all the time. Nobody wants the IRS to be their biggest beneficiary.
Right.
Or at least we haven't come across them yet.
Right. And so let's talk about when you pass on a Roth IRA, because we talk about the downfalls of passing on a regular traditional IRA. When you pass on a Roth IRA, I still have to take it out over 10 years. It's tax-free.
Yep.
So that's a huge benefit. It doesn't raise my income. If I'm in my peak earning years, it's not going to raise my tax bracket. But if I'm in my peak earning years and inheriting a large IRA, that's great. That's a huge benefit for anybody inheriting the money. But if your kids are going to pay 37% tax because you left them all this money behind, but you could have paid 22 or 24, I mean, it's a huge benefit.
It's a huge win. If we can pay the government 10% less on the same dollar amount, like that's a huge win. And people want to know about that. They want to take advantage of that. And to take advantage of that, again, it all comes back to tax planning, because we are looking at, the ticking tax bomb. I've heard it coined before, right? Yeah. Most of Americans have the majority of their wealth in these tax-deferred vehicles. Yeah. And that money's going to pass on through the great wealth transfer. We talked about that a couple episodes ago.
Yeah.
And I think that's just important to know how to, I don't want to say avoid that, but minimize that tax bill over your lifetime is something we should all be looking at.
That's partially the reason they changed it to the 10-year window, is they know that that's going to push people into higher brackets, and they want that because they want more tax dollars.
We have to, because we're in debt.
Yeah.
Like that's kind of why you got to do that.
Yeah. So the question is not whether taxes matter in retirement. The question is whether you are planning for them before they arrive. And we say that all the time. We have to have a plan. We have to look forward. We can't just look at what happened in the past. I hate most advisors' philosophies when they meet with people, and we've really changed this because we felt like there was something missing. We don't want to just report the past, right? That's great. We have to talk about past performance, but it should be a small portion of the conversation. We have to look at what's happening moving forward. What are we doing moving forward?
Yep. I couldn't agree more. We talk about it when we have strategy sessions with people, and we talk to our whole team about this. We're going to spend about 10 minutes looking in the rearview mirror.
Yeah.
And the rest of the meeting needs to be on what we're doing next.
Right.
Right. Because that's what matters. We don't control what happened. The markets have been great, right? We could all sit in review meetings and talk about that, and that's fantastic. But what are we doing next?
Right. So I think just to wrap it up, obviously taxes are a big part of our retirement. It's very likely that you haven't thought about it, but as you're saving money, putting money away, or getting ready to retire, it could be your biggest expense in retirement.
Most likely will. So people should have a plan for that. We know we do that each and every day, and we're very passionate about that, because I think you talked about it. We kind of opened it with this, but taxes are the needle mover in retirement. If you've been a good saver, tax planning is probably your number one concern right now. Make sure you're working with people who understand it.
Yeah. Yeah, so if you guys can, like the episode, subscribe, and share it with a friend if it's going to help them out. We love doing this, and we want to spread the message. So